Good afternoon. Good afternoon all, and kia ora to our friends from NZ. Welcome to a Fiducian Fund update to wrap up our calendar year of 2024. I trust you've all had a productive and successful year, both in your professional, but also your personal and family lives. We thought we'd actually do something a little bit different for today's webinar. And as most of you have gone through the Fiducian investment philosophy and understand the multi-manager or our manage the manager process, this afternoon, what we thought we'd do a little bit different is to actually invite two guest speakers from two separate managers who make up allocations in our most popular sector funds, being India and technology. But before we kick into it, just a little bit of housekeeping. Seeing that it is a bit later in the afternoon and we don't want to keep everyone too late, we thought we'd hold off questions until both speakers have presented. You'll actually notice on the right-hand side of this platform, there is a questions tab. So feel free to write down any questions throughout the respective presentations. And the moderators, myself and Diz, will actually select between, say, 3 to 5 at the end of both presentations, depending on time. So without further ado, I'd like to first introduce you all to Harry Morrow from Loftus, a manager in our Fiducian Technology Fund. Holding a Bachelor of Commerce from Sydney University and CFA accreditation, Harry joined Loftus in 2018. As a senior analyst, Harry supports both the PM and Chief Investment Officer in both analysis and modelling. Welcome and thank you, Harry.
Awesome. Thanks, Fiducian, for having me on to speak about all things technology. So just in terms of a quick agenda, in terms of what I'll be running through over the next 15 minutes, I guess the first point that I want to, and the question that I want to answer is why technology, why it's important to understand the implications of technology. And then following that, how can you harvest return from technology and its impacts on industries and markets? That's mostly kind of a backwards looking what's happened over the past decade. And then I want to go into, I guess, some of the key areas of focus that we see at the moment as, driving returns over the next decade, particularly with a focus on artificial intelligence. And then I'll quickly wrap up with, our view on the US elections and the potential impact on technology and the portfolio that we manage. But before I kick off, what I might just say is that, we look at the world through the lens of disruption. And so when it comes to technology, we view it as a means to an end, right? There's no investing in technology for the sake of technology. It's got to solve a problem. It's got to provide a better and more effective solution to businesses and consumers. And so that's the lens through which we view the world. So if you hear me refer to disruption, that's the way that we view the world. And we look at technology as a means to disrupt existing markets, but also create new markets. So the core belief that we hold is all industries are being disrupted, oftentimes, which is being powered by technology. So with that out of the way, I'll quickly jump into why technology. So if you look back 10 years ago and you look at the makeup of the top 10 companies in the MSCI All Country World Index back then, what you can see is that yes, Apple and Microsoft were there, but you also had banks, brands, and oil. If you fast forward 10 years, what you can see happen is that now the market is dominated by disruption, but technology fueled disruption. And so you can see that the top 10, 8 of the companies in the top 10 today, are technology companies, with the exceptions being Eli Lilly and JP Morgan. And so I think there's two key takeaways from this slide that I want to leave you with. But it goes to that first question that I asked in terms of why technology. And the reason that technology is important to understand and the implications are important to understand is because it has the power to disrupt and reshape entire industries and markets. And I think it's noteworthy that Microsoft and Nvidia combined today make up the same weight as the top 10 years ago. Two companies make up that same amount of weight. So these are companies that don't respect traditional classifications either. They're participating in multiple industries, and they've appreciated in value as a result. The second idea that I want to leave you with is that, you know, blue chip companies, existing blue chip companies that have benefited, that weight is made up of, you know, past success or reflects past success. There's actually a lot of risk, in our view, in holding market weights. I guess if you look at the 2014 top 10, a lot of those companies that you see there are no longer in the top 10. They would have either performed at the market or below the market. Whereas a lot of these disruptive companies are the ones that have truly performed well over the past decade. So, you know, technology fueled disruption is a very important thing to be mindful of, and it can make for a good investment strategy. But there's also the risk involved in being disrupted or being on the other end of technology. And I think if you look at this, the investment strategy to outperform that you would come up with is, you know, with the benefit of hindsight and perhaps a time machine, you would go back and invest in the companies that are growing to be a larger part of the index. But we obviously don't have a time machine. So how can we try to identify the companies that are going to become a larger part of the index and grow faster than the overall market? I'll come back to that in a second, but a quick question, I guess, is knowing how important these companies are today, the top 10 in 2024, what do you think the allocation to those companies back in 2014 was? 20%, 15%, 10%? It was 5% back in 2014. So what that says to us is that the market massively underappreciated and didn't benefit from, you know, the technology fueled disruption that ended up working its way through the market. Meanwhile, Loftus Peak's, the strategy that we managed back in 2014, our exposure to that top 10 back in 2014 was closer to 30%. And, you know, the point of this isn't to gloat. This is to ask the question, what was Loftus Peak seeing at the time that gave us the comfort, but also the conviction to have that allocation to these companies 10 years ago? And so I'll get into that now in terms of the process that we follow. You know, how do you harvest return from technology and its implications for all industries? The way that we look at it is, you know, you have to start by understanding the changes that technology is bringing to the world. So that's the disruptive lens here at the top, the qualitative screen. Are these companies beneficiaries of disruption, or are they losers of disruption? And if they are beneficiaries, then they make it through to the next stage, which is the quantitative screen component, which is, you know, you need a process and you need to be able to make consistent decisions as it relates to entering a stock and the valuation side of things. So that's where that becomes important. And then obviously the valuation flows through to the portfolio construction. In terms of the major secular growth drivers that we saw a decade ago, this goes to the point of what it was that we were seeing 10 years ago that gave us the conviction and the comfort to go larger in many of those names. These are four super important secular trends that were in full swing a decade ago. The shift to cloud computing, the rise of smartphones, global digital advertising, and US e-commerce. And so I think the consistent thing across all of these themes is that, you know, it is technology fueled, but it's a better and more effective solution. So for cloud computing, the main reason to use cloud computing was because companies would have to build servers with capacity for the busiest day of the year. So for a commerce company, you'd have to build it for, you know, a Black Friday sale that might be coming up, as opposed to cloud computing, where you could actually flex that and scale up and scale down on demand, which was a much more effective way of managing your server capacity. So it was a better and more effective solution, and it was also an enormous market that was being disrupted. Global digital advertising, that was obviously another key theme over the past decade, and you have companies like Meta and Google that have benefited from that. And again, there's an old adage in marketing that 50% of my marketing budget isn't working, I just don't know which half that is. Well, with digital advertising, you can actually understand which half of your budget is working and which half isn't, given the advancements in data, measurement, and attribution. And so, you know, Microsoft, Google, and Amazon all benefited from cloud computing. Apple was a big beneficiary of the smartphone and the rise of the services businesses that it built on top of that. Meta and Google benefited from digital advertising, and then Amazon obviously benefited from US e-commerce growth generally. And so these are the big changes that technology was enabling that were happening a decade ago that gave us the comfort in the direction of the world and the companies that were going to benefit from it. And so once we had that, you obviously need a process to be able to construct a portfolio. And this is quite a simple version of that. But I think the two most important points are one, a majority of the portfolio is high quality. And what that means is that these are established business models with potential optionality, and the potential optionality is not necessarily priced into the company, but they're also profitable, cash flow positive, and they've got strong balance sheets. And the reason that's important is because it enables the companies to withstand any turbulence or volatility in the market, whether that's macro related, political, geopolitical related, or relates to an election. It gives the companies the ability to withstand volatility because they've got cash on the books, generating cash from the business, and that they'll make it through the volatility that's being faced. The second part of that is that you want to make sure that the companies, a kind of internal saying that we have here is substance over stories. So we want to allocate more of our capital to the companies that we think have a greater likelihood of meeting our expectations as opposed to those with the greatest upside. And so what that means is not allocating more money to companies that might have a big part of their price tied up in a business model that might not even exist yet. We want to buy into companies where the original business isn't necessarily fully priced, and then there's additional optionality that the market isn't pricing in or realizing. And so putting that into practice over the past 12 to 18 months, but in relation to the Mag 7, 12 to 18 months ago, we understood the high-level trends. Those 4 trends that I mentioned before, they're still going. We understood that they were going to continue going, but I think the market questioned whether or not digital advertising would return to growth, or US e-commerce or cloud computing would return to growth, and they have, because they're better and more effective solutions. So that's the high-level component. And then on the valuation side of things, with non-heroic assumptions, you're able to get significant upside from a lot of these names. And so that's what gave us the comfort and conviction to have larger positions in these companies, 12 months ago even. But as those companies have appreciated and began butting up against our price targets, we've obviously got to reduce those names and perhaps allocate to other companies that might be beneficiaries of a similar theme, but with more upside, and that we have more certainty in that upside. I think probably worth sticking on here is in NVIDIA and Apple. We like the companies, they're great companies, but great companies don't always make great investments. And we think that there is a lot of optionality that's beginning to be priced into Apple. And NVIDIA, you do have to make heroic assumptions in order to make the valuation stack up there, which is why we've subsequently exited those companies. But they're on our bench, and if they come to within an acceptable price range, we'll happily re-enter both of those stocks. So hopefully that gives you an understanding of, I guess, a way to look at technology, the implications that it has on industries, and then a process for harvesting return from that. And then to go and take, I guess, a look forward. These are some of the focus areas that we're looking at the moment that we think are going to be, grow stronger than GDP over the next 10 years. And so those are streaming, life sciences, semiconductors, software-defined vehicles, and of course, artificial intelligence. So given the time constraint, I might just focus on artificial intelligence. But the way that we look at artificial intelligence is that it's got to be a portfolio approach, and it has to respect the disruption life cycle. So as you're all probably aware by now, semiconductors are very important components for technology and are the bedrock for a lot of disruption that's happening in the world. And so NVIDIA is probably a household name at this point, even though it wasn't 10 years ago, AMD and TSMC as well. And so what has to happen is that the infrastructure has to be laid before you can even get to the cloud players and the applications. And so what's been happening over the past 12 to 18 months is that there's been a scramble to invest in the infrastructure to support artificial intelligence. And so, of course, that means accelerated computing and processors like NVIDIA, the ones that NVIDIA and AMD supply. But in terms of understanding the artificial intelligence theme, it's a whole ecosystem. And so it's not just the processor, but it's also the networking. And so companies like Broadcom and Arista are also incredibly important to that ecosystem. And then once you accelerate the processing power and the networking, you also need the memory to be able to keep up with that. And that's why SK Hynix is a very important company in that respect. So at the heart of it all, I think we're all familiar with TSMC by now, but they produce 90% of the world's leading edge chips. And so this kind of makes up the tools component. And the last thing that I'll mention is that it hasn't really happened yet, but a lot of the AI that you're seeing today that happens in the cloud with ChatGPT-like capabilities, what you're going to see, over the next 12 to 18 months, maybe even 24 months, is that a lot more of this will be pushed to the edge. And what I mean by the edge is laptops, smartphones, and other devices. And the reason it's going to get pushed to the edge is because it's much cheaper for the application to do that. So as opposed to having to pay a cloud to run whatever AI it is, it's much cheaper to do that on the phone and on the device, because that's the consumer paying for that energy as opposed to the cloud. So that's the tools side of things. The enablers, obviously Microsoft, Google, Amazon are putting tens of billions of dollars into data center infrastructure at the moment. I guess the big question on investors' minds is there going to be a return on that investment, and what's going to happen to profitability? And so one of the concerns for these companies is that the investments that they're making today are going to put pressure on earnings over the next 12 to 18 months, and that will reduce earnings, and it's a reason to be cautious about perhaps some of these players. And then on the beneficiary side of things, more traditional AI beneficiaries, you've got companies like Netflix. Their recommendation algorithm is an example of AI. Facebook and Instagram, the news feed that you scroll through is an example of AI. And perhaps one that you're less familiar with is John Deere, which has integrated a whole lot of technology into its business to actually introduce a services component to what was traditionally a hardware business. And one of the examples of that is the use of computer vision to identify weeds on farmland, and they can automatically identify it and then spray it with the exact right amount of weed killer. And that's a massive value add to the farmers, because it obviously delivers a better and more effective solution. So that's the traditional AI side of things. And then on the more generative AI side of things, it's worth noting that we're still very early on in that journey. Some of the obvious solutions that we're seeing today involve things like coding, as well as customer service. On the customer service side of things, I don't know if any of you have tried to interact with, maybe a bank's assistant, but it's often quite tedious and painful to get any outcome that you're after. And so what generative AI promises is for that to be a little bit more of a dynamic as opposed to static process, where you can get to the desired outcome. So this is Loftus Peak's kind of portfolio approach to AI. We're seeing a shift from tools to enablers to beneficiaries in terms of exposure to companies. And we would expect there to be many more beneficiaries to come as generative AI continues to evolve. So wrapping up quickly just on the US elections, obviously a very topical and important point at the moment. I think from our perspective, the market is familiar with Trump's approach. We managed the portfolio through his last presidency. The portfolio actually did quite well. That being said, he's likely to be more effective this time around because he understands the system a lot better. But that doesn't mean that you can't, or that doesn't mean that you throw out the financial playbook entirely. There will be more volatility and noise, but you have to focus on the fundamentals, revenues, earnings, cash flows, and valuations. And you have to assess the impact of any of those policies on the fundamentals. And so some of the early changes that we've made in our own portfolio is that we've slightly reduced the Magnificent Seven. Part of that is valuation and some of the reasons that I mentioned earlier, but part of that is that they've got a target on their backs with the new administration coming in. And then semiconductors, we've reduced a little bit, again, valuation based, but also the potential risk from tariffs. So, and then on the flip side, we've increased allocation towards software, which is a little bit more Trump agnostic, as well as some of the SMID caps and beneficiaries of a cyclical recovery that are yet to participate in the market. So maybe just to wrap up quickly, hopefully that gives you a little bit of an understanding of how to look at technology, why it's important to understand the implications, as well as a process that we use to harvest return from it, as well as a couple of focus areas that we think are going to present some good growth over the next decade. I'll wrap up with that.
So yeah, thanks again, Harry. I know it's only a short period of time to get a lot across, but I think you covered a lot in that period. So yeah, many thanks to you for that one, mate.
Awesome.
Now I'd like to introduce you all to Ashish Wakankar from EquiPoise, a manager in our Fiducian India fund. An esteemed guest with around 30 years experience in the funds management industry, Ashish has not only built one of the largest offshore funds management businesses in India, but he also launched many successful offshore funds based out of Luxembourg, Japan, Hong Kong, Singapore, Australia, and the US. Welcome, and thank you, Ashish.
Opportunity to present my views in front of an esteemed investor audience from New Zealand. Like I was introduced, I have been associated with the Fiducian India Equity Fund right from its inception in September of 2007, but through different organizations. Been advising the India portion since October 2021 as part of EquiPoise. Lots of things to cover in this presentation, particularly the reforms, the aggressive reforms that the government, which has been in power for last 10 plus years, has embarked, and the result of that, which is seen in the economy and hence on the markets. James Carville, this is a name probably many would have heard of, the famous strategist, political strategist for President Bill Clinton. And he came up with a tagline, "It's the economy, stupid." That one line kind of swung the election in favor of President Clinton. It is indeed about the economy, and hence the topic that I have decided to cover, an economy which is on the front foot. During the presentation, we will cover India in numbers. Basically, it's important to get a perspective of India. The motto of the government, which is reform, perform, transform. It's been a decade, as I said, for this government. It's got re-elected for the third time, and the changes that have taken place, we will try to look at that, the reforms that are driving the economy. Let me put a timer, so that's why. India is emerging. I mean, people know about India as IT services and IT exports hub, but global services exports is something that is picking up very strongly. It's having its effect on real estate, having its effect on jobs, foreign exchange. We will cover that. Fund flows. A lot of concern is the market, which has run up in the last 3-4 years non-stop. Is it expensive? Trump 2.0, the impact of the oncoming presidency effective Jan 20. What are the risks to our view, and conclusion? Before we start, it's important, I think, to get a perspective of the country itself. To appreciate the size of the opportunity and the challenges. India is now the most populous country in the world with around 1.44 billion. It's a population which is growing at almost 1%. So to give a number in perspective, we add 2.5 New Zealand every year to our population. The median age of the country is around 28. Inflation is well within control of around 4%. The real GDP growth rate of this country makes it the fastest growing economy in the world, growing at a real growth rate of around 7. The GDP in dollar terms is now 3.9 trillion, making it per capita at around 2,700. And in purchasing power parity terms, the GDP of India is 16.02 trillion US dollars, making per capita GDP of around $11,000. So based on this, on PPP terms, share of world GDP, India's share of world GDP is about 8%. Just to get another perspective, around 961 million people in this country are in the working age group, which is around 15 to 64. 68% of India's population is in the working age bracket, as you can see from the chart in front of you. The median age I've already spoken of, it's around 28. Unemployment rate is comfortable 4% and is at a 5-year low. Nearly 45% of the employed population is involved in agriculture, which actually is the net supplier of labor to the manufacturing and to the services sector. I mentioned India is the fastest growing large economy, growing at around 8% for the last 3 years, real growth. As per various agencies, India is expected to grow at around 6.5 to 7% in 2025 as well. So we are talking of an economy of US dollars 3.9 trillion, growing at around 11% in nominal terms. Currently, India is the 5th largest economy in the world. There is a near consensus that India will become the 4th largest economy in next 2 years and go on to become the 3rd largest economy in the world by 2027, which means India will have by 2027 an economy which is 5.4 trillion US dollars. While the above estimates that I've shared so far in the previous 2 slides, the table, are from IMF, but World Bank numbers are also similar is what we have seen. And now let us take a look at the numbers coming from S&P Global. S&P Global estimates, and even others do, that India's economy will touch $7 trillion by 2030. Please note, India is already in 2024 a USD 16 trillion economy in PPP terms. So at $7 trillion, India's per capita GDP or per capita income would be around $4,500. Current it is 2,700 we've seen, and in PPP terms it is already 11,000. Capital accumulation is the main driver in our opinion. Investments are running at a 10-year high of 34% of fiscal. The growth contribution from productivity is higher than the previous periods due to creation of physical and digital infrastructure. So this is something which has been a game changer as far as India is concerned. The entire focus has been on building physical as well as digital infrastructure in conjunction with efficiency enhancing reforms. Despite this, the share of, the focus on manufacturing, despite this, services will continue to play a very strong role in the economy. I mentioned the motto of this government is reform, perform, and transform. India has had a very stable government for last 10 years, a majority government at the center, which is something that has not been there for a pretty long time. And that's one of the concerns that many had. It not just has a powerful government at the center, it's the same party which is ruling in 21 other states of this country, making reforms, pushing the agenda of growth that much more easier. I mentioned India has this government has received a mandate for the 3rd time, and as we speak is all set to complete its term, which began in May of 2024 up to May of 2029. Entire focus, as I mentioned, is on building infrastructure and ensuring investment-led growth. There is no concept over here of giving doles to the people and pushing the economy through a consumption-led growth. The impact of investment, impact of capital expenditure, impact of infrastructure built on the economy is the path this government chose. And it chose even when the country or the world was facing COVID crisis. What has changed during the past decade? Well, this has been a decade of game-changing reforms as far as India is concerned. GST implementation was done. Bankruptcy and insolvency and bankruptcy code was put in place. A mammoth or demonetization drive to weed out the use of cash from the system was initiated Many thought this was near suicidal step taken by the government, but what we see today, and in the subsequent slides, you will watch it, the effect of demonetization has been humongously positive on the economy. The Reserve Bank of India has been given a clear mandate to target inflation at 4% and a tolerance limit of plus minus 2%. So the inflation target is the main focus of RBI, and it has to maintain it in the range of 2 to 6%, which it has been doing successfully. And the impact of that is also felt on the economy, hence on the markets, and we will cover that. Formalization and digitalization of economy. A fantastic path-breaking reform that took place over here, which resulted in empowering and bringing nearly 500 million people into the formal economy, because these 500 million people were all this while non-bankable. I mean, they did not have even simple things like a bank account, and made their KYC near impossible. The formalization and digitalization of the economy, and we will discuss India Stack, is one of a game changer. And last but definitely not the least, the Real Estate Regulation Act that was put in place has resulted in massive cleanup of the real estate sector, which has caused pain to the banking system. One more, I should have covered it over here. One more game changing, and to address the China Plus opportunity, which has come up, the West looking at it, and that is productivity linked incentive, or PLI, which India has put in place. I will cover that in the subsequent slides. I spoke about India Stack. Now, those who have been to India in recent times have experienced rapid strides India has taken, and makes it, puts it miles ahead of in the world of digitization. India Stack has made the world sit up and look at a population scale technology, which the base layer is Aadhaar, or KYC based identification. So what is India Stack is a moniker for a setup of APIs and digital public goods that aim to unlock economic primitives of identity and payment at a population scale. The result of India Stack has been felt on cashless transactions go through the roof. We will look at the numbers, staggering numbers over there. The way Indians transact, the way they buy property, the way they pass through airports, the way their identification documents, right from school to their graduation, to their driver's license, to their social security number, to their income tax account number, everything. The works are there on your mobile. It's there on this India Stack, and it is an initiative of the government of India. And some of the players who sit on India Stack and are beneficiaries are the likes of even Google, Walmart's PhonePe, and likes of Amazon. The largest beneficiary, as I said, of this initiative has been the common man. Nearly 500 million Indians who were all this while unbankable are now part of this formal economy thanks to India Stack. Bankruptcy. So one of the things that the changes that took place I spoke of insolvency and bankruptcy code that's helped resolve bank loans and clean up the banking system. Bank loans as a percentage of the total is down from nearly 10%, which was when the cleanup started. The first step that the government took was to identify and recognize that there was a problem and not just push it under the carpet. So these bad loans have always been there, but the cleanup, the recognition and the cleanup never took place. That has happened, made the entire financial system in this country healthy. We spoke about India Stack, and I spoke about digital payments. UPI, or Unified Payments Interface, as we call it, rides on the India Stack and is developed by the government-owned National Payments Corporation of India. Digital payment transactions stood at 131 billion in financial year 2024. This is going by the numbers. If I were to extrapolate that, going by the 102 billion transactions which have taken place till October, we are looking at 190 billion transactions volume of number of transactions in 2025. The digital payment transactions in value terms stand at 199 trillion rupees in 2024, which means it should touch nearly 270 trillion in 2025. That's going by the trend. As I said, adoption of UPI and digital payment has been extremely beneficial. You can sit into a cab, you can sit into an auto rickshaw, you can go to a vegetable vendor, and you can buy. The result of and use with your pay them with the use of a mobile phone. You can buy something as low as probably 10 pence worth of vegetables with the use of your mobile phone. The wonderful part this has done is it has brought these 500 million common people of India into the formal banking system. They today have a credit history. They today have a banking or transaction or cash flow history. They did not have any, making them eligible for loans, bringing them into the formal economy. So if one were to look at the value and the volume, we are talking of an average transaction value of somewhere around $15. That's as low as it goes. But as I said, you could go ahead and simply buy something worth even 10 pence. Aggressive fiscal consolidation is something that the government initiated. It came to power in 2014. But unfortunately, what we saw in 2021 was COVID, which resulted in the glide path taking a backseat, and rightfully so. But the government, post-COVID, has embarked on the glide path of sharp fiscal consolidation and has always, budget after budget, year after year, surpassed its own targets. For the lack of time, I will move. But the one chart I would like to bring your attention to, we spoke of fiscal deficit to GDP trend, the glide path downwards. The second part, as you can see, the central government capital expenditure. The capital expenditure in absolute terms has been going up. It currently stands at, it was around 3.4 trillion rupees, just about, or 2 trillion rupees about 10 years back. It today is at 11 trillion, making it close to about 3.5% of the GDP. The clear focus, I spoke about, is on infrastructure and on capital expenditure. The numbers are here in front of you. I spoke about this part, RBI's mandate. The Reserve Bank of India has been given a mandate. As a result of this, as a result of sharp focus and a good teamwork between the central bank and the government, India-US real interest spread is nearly 0 percentage points now, lower than its 5-year average of 2.8 and a 10-year average of around 2.4%, which clearly means the inflation in US, and hence the yields have been higher. We've had rates, unchanged rates in India, policy rates, since April 2023. It's been more than 2.5 years now, the rates haven't moved. Currency as a function of that has been stable. India's forex reserves as we speak are at around $658 billion, making the import cover at over 11 months. With the use of technology and lowering of corporate taxes to 15% and 25%, and improved tax compliance, the number of tax filers, individuals, has gone up significantly.
Sorry, Ashish, just looking for time-wise.
Yes, I also saw that.
Might have to stop right there, but I'm sure everyone can agree that it's quite informative.
No, what I would do is
pick this up in another webinar in the new year, because there's a lot of great content here. And to be fair to everyone on the conversation, look, there have been a few questions that have come through, but just looking for time, I don't know if we will be able to get to those questions just this afternoon. So my deep apologies, but both Diz and I will obviously collate through them and we'll get them answered for everyone in the new year. So in order to wrap up, I just thought, let everyone know once again, or revisit the fact that Loftus Peak. Sorry, I'll just get my face back. Thanks.
No, that's fine.
Thanks, Ashish. So wrapping up, both Loftus Peak sit within our Fiducian Technology Fund, and EquiPoise sit within the Fiducian India Fund. and both represent sizable exposures within their respective Fiducian funds. And both were selected using and monitored through the Manage the Manager process. In terms of long-term returns with the Fiducian Technology Fund and the Fiducian India Fund, they've both been exceptionally strong, and the Fiducian Technology Fund has returned 16% per annum over the last 15 years, and the Fiducian India Fund has returned 11.9% per annum over the last 15 years, meaning that $100,000 invested in the technology fund 15 years ago would be worth $926,000 today, and $100,000 in the India fund 15 years ago would be worth over $540,000 today. In terms of New Zealand, these funds are available both on the Concilium and Aegis platforms. And as mentioned, both Diz and I will touch base in the new year. So I guess all that's left for me to say is that we appreciate you taking the time to attend today's webinar, and we obviously wish you and the family a Merry Christmas and a Happy New Year. Thank you so much, everyone.
Thanks for having me on. Appreciate it.
Thank you.